Imagine waking up 20 years from now and realizing you're broke. Not because you didn't make money, but because you didn't invest it wisely. Sounds scary? It should be. Because the truth is, time is either your greatest ally or your worst enemy when it comes to building wealth. In the next 20 minutes, I'm going to give you a step-by-step investment plan that's built for long-term success. Not some TikTok trick, not a get-rich-quick scheme, but a real plan. The kind that future millionaires follow quietly. And no, it doesn't involve selling your kidney to buy Bitcoin. Stay with me till the end, because I'll reveal the one strategy that quietly outperforms even the S&P 500, but barely anyone talks about it. Let's be honest. If you're in your 20s, you've probably thought, I'll start investing once I make more money. Here's the harsh truth. If you wait for perfect conditions, you'll wait forever. Start investing $200 per month at age 20 and earn a modest 8% return. You'll have around $115,000 in 20 years. Start at 30, you end up with less than half. That 10-year delay costs you nearly $60,000, not because you didn't save, but because you stole from your future self. Think of your 20s as financial puberty, uncomfortable, messy, but critical to how you grow. Section A, the core foundation. Your 20-year plan begins with one thing: consistency over complexity. The best investors aren't the smartest, they're the most consistent. Step 1, emergency fund. Before anything else, build a 3 to 6 month emergency fund. Why? Because investing without a safety net is like skydiving without a parachute. Step 2, max out Roth IRA, first 6K to 7K per year. A Roth IRA is your tax-free retirement weapon. You invest today, and your money grows. Then you withdraw it tax-free in the future. That's legal tax evasion, the good kind. Section B, index funds and ETFs. Once your Roth IRA is funded, put your money in low-cost index funds like VTI or SPY. You might ask, what about crypto, real estate, or the next Tesla? We'll get to that. But first, understand why this boring strategy makes people rich. Index funds let you own the entire market. They're diversified, resilient, and require zero stock picking skills. Even if you just invest $500 a month for 20 years in VTI, you're looking at nearly $300,000, assuming average returns. Section C, dollar cost. Averaging timing. The market is a game for gamblers. Winning consistently, that's for planners. Introduce DCA, dollar cost averaging. It's simple. Invest the same amount regularly, whether the market is up, down, or sideways. It evens out your risk over time. It's like going to the gym. One day, you lift 100 pounds. Another day, just your emotional baggage. But you still show up. Section D, diversify. But not too much diversification protects your downside. But over-diversifying is like putting a spoonful of peanut butter across 100 slices of bread. It doesn't work. Stick to 70% in broad market ETFs like VTI, SPY, 20% in bonds or REITs for balance, 10% in high growth sectors like tech or emerging markets. This way, you have exposure, stability, and growth all in one portfolio. Anyone can invest for 6 months, but wealth is built over 20 years. In the real game, it's mental. You'll see crashes, inflation, maybe even a recession or two. But staying the course is what separates winners from wishful thinkers. Now, as promised, here's the hidden gem strategy that outperforms the S&P 500 target date index funds. They adjust your risk as you get older, automatically shifting from aggressive growth to stable income. It's like cruise control for your portfolio, smart, simple, and effective. Your future isn't built in 20 years. It's built in the decisions you make this year, this month, this week. Start small, stay consistent, and you'll look back 20 years from now, grateful you didn't wait. If you want to dive deeper into why you might still overspend, even when you know better, check out this next video, The Psychology of Spending Habits. Click it now, because mastering your mindset is just as important as mastering your money.